Good morning, ladies and gentlemen. Well, according to my manual calculations, the risk dial is stuck around -20, so we are firmly still in risk off. We got a nice little panic on Friday and probably a continuation of that panic sometime next week. But I believe that we are close to another tradable bottom. And I will give you my reasons and I will give you my intuition over the course of this video. I am still firmly of the opinion that there's very little to be learned from the yield curve. It has lost its predictive power at the moment. I think all the important parts like the 530s are basically stuck now waiting for the Fed. It's only if they start making new highs or basically new lows in how shall I say, if it starts inverting, that it's going to have some predictive power. But I think at this stage is just a question of waiting and seeing what the Fed does. I don't think the Fed is going to give us any surprises. I think, if anything, they will be more hawkish, and the more hawkish they are, the better for the markets. The spread between the overnight rate and basically 1 year is as wide as I have ever seen it. And really what it's saying is that the market has reached the level that the Fed needs, first of all, to catch up with before the market gives it any more indications. I would be very surprised if the Fed is less hawkish. The less the Fed is hawkish now, the more the yield curve will actually come down, and bonds will not like it. So I think if the Fed is smart, it's going to continue to be as hawkish as possible, and that will hold the 30s, and all the pressure will continue to be on the 2s and the 5s. The 5s have basically reached the 3% level, which I thought was the ultimate target. And if we enlarge that and we go back in time, we will see that this 3% level, really, we haven't traded any higher than this since '09. And that is probably a decent place to wait for the Fed to do something. And then if the Fed does do something, the danger is that we go down in yield back towards 2.5%. And basically we trade something like this between 235 and 3. That would not surprise me at all. So I'm more constructive on fixed income than most people. And just because we have reached the levels that I thought we were likely to reach, and then we could be in a protracted period of time where we just trade sideways in a 50 basis point range before trying to make another high. But I think that it's going to take a long time to do that. We have a lot to digest. I don't see any reason to start getting panicky about what the bonds are going to do now. We've basically done it all. We've spiked, we've reached these levels. I think it's much more likely that we stay here for the next couple of weeks waiting for the Fed, and then slowly come back down towards this 235 area. The 10s and 30s are also a whisker away from this 303-298 area. I would like to see it achieved and then basically do something like this over the course of the next few weeks, trade between 273 and 3. I really don't see why we should start panicking now. What numbers are we going to get? They're going to panic us. we basically, as I'm going to show you in a moment, we have reached the zero real yield level, and that is we are unlikely to need to accelerate away from these levels unless we see an acceleration in inflation. I think that is not extremely likely at the moment. And if we have a look at the 30s, I still, this is TLT, I still think this 115.26 level is extremely important and the kind of level that I would like to have some call spreads for a return towards 127. What would that mean in terms of yields in the 30s? Well, that would mean reaching 320, something like that, and then coming off back down towards 250. Or at the very least back to these levels. So what I'm saying is that I see very little upside in bond yields, 10, 15, 20 basis points max, and then I think that we are probably in a trading range of 30, 40 basis points to the downside, and that should be enough to stabilize equities at the levels that we will look at later, and the reason is that the bonds, I don't think, trade through 320, because I just don't think that we're going to get the acceleration in inflation that would imply. And here we have the 10-year break-even inflation rates, 298, 10-year around 291. So we're basically at zero. What does that mean? That means that if you were to buy 10-year notes, the market is not anticipating that you are going to lose money in real terms over the course of the next 10 years. That is a reasonable level to wait for the Fed. I think any further spikes in 10-year notes to the upside in yield are probably a buy ahead of the Fed. And as I keep on saying, the more bearish the Fed is at the moment, the more hawkish they are, the better the long end will hold in. Because what the long end wants is a Fed which is aware of inflation, is concerned about it, and is prepared to go faster to reach the levels the market is at the short end. So if you look back at these videos, even a year ago, I was saying that I really would not be surprised to see a flat yield curve. And that is when the yield curve was actually very steep. Now we have reached that flat yield curve, and now I'm saying that I really don't see any reason why we should have anything but a flat yield curve and things stay here and stabilize here. To get bearish now, you need to see an acceleration in inflation, and you need to see an acceleration of this five-year forward rate. As long as that one is around the 250 to 275 level, that is not what you are really getting. You need to see this above 3 to really start getting bearish on the bond market again. I think it's far too late to get bearish on the bond market. It's probably time to start getting bullish on the bond market at the levels that I've mentioned. So as long as the Fed is not bearish, as long as the Fed is just as hawkish as they are talking, and they come out with hawkish predictions about their actions in 2 weeks' time, I am going to be a better buyer of bonds, and I think that will stabilize everything. So what I'm saying is that I think it's too late to get bearish of the US, but I don't think it's too late to get bearish of Europe. The Fed is doing something, the ECB is still doing nothing. This is the Schatz, and I think this level here, it's a monthly chart, this 34, 35 level is going to be extremely important. What are the alternatives? The alternatives is that basically we will be stuck between, well, let's call it 0, that's -7, and this 35 level for a long time. Okay, this could be a year plus, or we just break higher and go higher. I am biased towards breaking higher and going higher because I don't think that the ECB is going to be, once they've changed policy and actually decide that tightening is the only thing that's going to stop inflation, it's not going to be a 25 basis point event. It's not going to be a 50 basis points event. Just like the Fed and just like the short end in the US is saying that they need to take rates above neutral, so the ECB is going to need to take rates above neutral. And if neutral in the States is 2.5, and let's say that neutral in Europe is 1.5, well, it needs to take rates above 1.5. I think the differential in rates between Europe, certainly at the short end, between Europe and the US should be around 150 basis points. So that is neutral plus some more. Well, 150 basis points differential, and let's say that the Fed takes it up to 3%, that would give us around 150. Let's split the difference and let's say that this is the 0.382 retracement of this whole move, and that gives us 120. Okay, and this gives us this area where we traded for many, many months back in 2009. I think that that is more than likely. I would not bet against that at all. I think the risk reward here is that we either do something like this for many, many years, or many, many months, i.e. a couple of years almost, or we break higher. My bet would be that we break higher and we go to at least this 1% at the very short end. And another reason why I think we are likely to break in those twos, in those Schatz, is because the Bobble and the Bund are breaking up towards this 1% level, and I think that we are likely to get a flat yield curve, just like we have a flat yield curve in the US. We are likely to have a flat yield curve in the EU as well, around the 1 to 1.5% level. I believe that the inflation differentials and the growth differentials certainly justify a difference of yields, of higher yields in the US than in the EU. But I also think that that yield differential does not belong at 2% because inflation is a global phenomenon. If they are going to reduce inflation in the EU, it's going to have to, they're going to have to raise rates to this kind of level. So to me, there's no hope for the Bobble before it reaches this, what's that, 95 level. And if we have a look at the bonds, I don't think that there's much hope until we reach this 113 level. I certainly am not a buyer of them until at the very least would reach those levels. And I don't think it has anything to do with French elections or anything else. It's just a catch-up. Basically the EU is catching up with the level of rates that are in the US. If we have a look at France, which really is the clearest of charts, the level here is 171, so we have another 30 basis points here. And I think the global rates are being pushed up by the catch up that is happening now in Europe. And really, I don't want to buy bonds until they reach around 170. And that is the reason why I'm not buying the US as yet. And I think there's a hope that we see 10, 20 basis points more there, and that those will be excellent levels to buy. So there you have it. I think bond yields are in the US are getting close to where they are going to go sideways for quite a bit of time, unless we see those inflation expectations de-anchor, which I think it's unlikely over the course of the next month. And I think all the bearishness is still going to be reflected the in European rates, and I think certainly that the short end of Europe is doomed. What to say about the dollar? Well, it keeps on doing exactly what it should, and holding all the levels that it should. Here you can see how this 99.79 level last week was basically the low, and it's pushing up towards 101.92. If we look at the weekly chart, and I think this is very informative, I think basically 102.82 is the level that you have to look at over the course of the next 2 or 3 weeks for it to reach. But I think that slowly, the differentials, the interest rate differentials are turning in favor of the euro. At the moment, the problem is that the Japanese are doing what they're doing, and they're holding rates at a quarter, and that is pumping up the dollar against the yen. I think it's going to be very difficult over the course of the next several months to take out 102.82 with any conviction, unless a new reason develops. I think with the facts we have at the moment, 102.82 is about as good as it gets. And if we turn that to a weekly chart of Euro USD, that would mean basically to me that we take out these lows and get everybody bared up, and then get ready for a new rally, that takes us back towards this 110 to 113 area. But I certainly think that first of all we take out these lows. Certainly we test the weekly low around the 107 area, and then we take out these lows at 106 and get everybody bared up. And once we've got everybody bared up and we've reached that 102 odd in the Dixie, it'll be probably time to rally again towards 110 to 113 as those interest rate differentials turn in favor of the euro, and Europe finally catches up with the US. I think as soon as it's, to me, this is a buy the rumor, sell the fact kind of market. We have even if we get a hawkish Fed, that will probably be the opportunity to lighten up on long dollar positions and go neutral on the dollar, because really what we are achieving by a hawkish Fed is stable long-term rates. And if long-term rates like 20s, 10s, 20s, 30s go stable in the US as a result, as I showed you in the charts earlier of the long-term bonds, then that will allow for the EU rates to start catching up, and for those differentials to start coming down towards the 150 area where I think they belong, and that should then allow for Dixie to trade back up towards these levels around 111, and in the DXY, if we go back to this kind of area, around the 95 area, 95, 95 and a half, 96, let's call it. So that would be a from 102 back down towards 96 and stabilize down there. I think gold is going to be very interesting over the next couple of weeks. We can see what it's done on the weekly. We tried the upside, we failed, we've come down to 1934. Now, if you look at how that looks on the dailies, that is a very, very interesting look, and I really want to enlarge this. Basically, the lowest close we've had since the invasion has been around this 1910, let's call it 1905 to 1915 area. I think the market wants to break it. I think the market wants to break it, and it wants probably to do an ABC all the way down to 1830. I think 1881 is going to be the first really big support from which we get another bounce towards 1930, and then I think it breaks it and comes down to 1830, and that is really going to be the level probably in a couple of weeks' time from which I can see a longer lasting move higher. How does that fit in with everything I've told you so far? Well, it fits in with the bonds not really coming off, i.e. keeping relatively stable at higher yields, and also with the dollar doing a little bit better, towards that 102 something area. And that probably will be enough to panic, some technicals to get us down here. And that will be the level that is good for it. Why? Because the bonds will no longer be pressuring it, if I'm correct, and we start going 30, 40, 50 basis points down in the US. And if the Dixie turns and from 102 it goes down to 95, 96, that should give us from here, from this area here, the impetus to go back up towards 2050. I don't think inflation is going to moderate. What I'm saying is that I don't think inflation is going to accelerate. And that should be enough for people to stop all these guys out. So basically anyone who is long from here above 1907, I think around 1900 pukes it. Yeah, and then it breaks 1883 at some stage and comes down to the 200-day moving average around this very important 1840 level, 1830 odd. And I think that from there we can have a sustained rally as the Dixie turns. To me, DBC has now shot its bolt. You can see what it did last week. We tried the high again, right? We had every opportunity to make new closing highs, certainly above the previous week, and boom, down. To me, there's absolutely no reason that we shouldn't test these lower levels around 25.60. And what is interesting is if we have a look at the DBC over gold, we are right there. Okay, we're right there. This chart is saying now you should really favor gold over DBC. But if I'm not that bullish of gold, then I have to be even more bearish of DBC. And that is another reason why I don't think bond yields are likely to continue much higher. And if we have a look at what Dr. Copper did last week, that's what Dr. Copper is saying. Quite a hard break. Does it go a million miles? I don't think so. We go back to these levels, 4,000. But that should be enough to take out the immediate bullishness of DBC and commodity and actually stabilize bonds at these levels. So everything that I see tells me that if bonds start going up in yield, you should fade them. I think the US yield curve will remain stable. I think the fact that the Dixie tightens conditions in the US is probably going to be enough to stabilize bonds. So really, I don't see much upside in bonds and in bond yields, and therefore I don't think that bond yields are going to pressure other assets over the course of the next couple of weeks. Are we going to get a growth scare in the US? I think yes, but I don't think it's going to be now. As long as these Blue Angels keep on going up, I think it's unlikely that we get a real, a lasting scare. Now, could we take out the lows? Yes, I think we will, but I think we are going to bounce straight back to the times 18. This is not the time to panic. I think until we start seeing a longer period of these averages moving towards the flattening, like we did in various other periods when the market actually started going down, I really can't see that we're going to move too far down in the SPX, simply because I don't think bonds are going to start now to accelerate higher, which would justify a lower multiple of times 16, let's say. I think this times 18 level is going to hold. I think it was just like I thought it was ridiculous when we were trading at times 20. I think it would be unlikely that we trade and stay below times 18 at the moment. Does that mean that we can't take out the lows? No, it just means that we go right back to it once we've taken out everyone and everyone is bearish. And everyone is bearish. I mean, what more do I need to show you than this level of bearishness? Now, is the market fairly priced? It's probably still a little bit rich, but we're not talking about dozens of percentage points. We're talking now about single-digit percentage points. So I don't think crashes happen when the bull-bear ratio is at 0.3. What we could get is some sort of a spike down, which is then immediately reversed. That's the kind of scenario which is much more likely than a continued pressure in the market. When in any doubt, I go back to my cleanest chart with the cleanest levels. And here we have 42.55, where we basically just about got to on Friday. And was it a surprising move? No, as I said, as soon as you break this 43, 84, 85 level, you have air. You have 1, 2, 3, 4, 5, 6, 7, 8 days of support broken, and then you just go down because there's no buyers. 42.55, 41.28. Those are the two levels. Now I think that 41.28 trades simply because the market got so bared up, and I will show you some sectors later and some individual shares which should justify those levels. But I think that is roughly the times 18 level that I showed you, and anything below there, and let's go back and see what could happen below. You are basically looking at this area here. You're looking for 39.84, where we had this massive run up last year from 39 up to 41.28, and basically traded 41.28 for a long time before we started breaking higher. Would I be surprised? There's a gap here, 4,018. Would I be surprised by that? No, not really. But I think from there it bounces, and it bounces quite hard, and it bounces back to these kind of levels, 4,200 at the very least. Where will I be a buyer? Well, I'll be a buyer between 40.77 and 39.83. Next week. Those are the levels that I would love to see. Certainly by 40.78 I'm long of calls. By 39.83 I'm long of everything. I think that we will get a bounce from this area. If we see it. I mean, I'm not saying that we see it, but I certainly think that from that area the risk reward is massively to the upside, and at least to this area, which is the 42.55 to 42.20 area. That will be certainly the bounce, and that is good 5-6% at least in terms of bounce. I just don't see that the growth scare is going to be enough at the moment, not ahead of the Fed. I just don't see the reasoning for it. Can we come down and test all these levels? Absolutely. Can we? There's, as I showed you, there's a gap here. Fine, but these are going to be the levels that I want to get long at. If we look at NQ, basically, this level of 14,300 or just below 14,300 was basically resistance all week. We traded in a very tight range all week, and we couldn't sustain it. And as soon as it started breaking, it broke hard. If we have a look at this chart, really, what are the levels that this is likely to trade at? And where is the really, really good support going to be? I would argue that the really good support is going to be between 12,400 and 12,700. This kind of area to me is going to be very, very pivotal. And I would only change my mind about SPX if we started breaking below there. You can see that here we have a massive gap all the way down to 12,000, just below 12,400. But this is the level that I would love to see it. And actually, I think that if bonds do what I think they're going to do, NQ is probably going to be a better buy down here than SPX. But we will see. So 12,700 to 12,400 is what I would love to see for a very decent bounce. The one I believe that can still be shorted and stay short of is XLY. I think XLY next week could easily come down to these levels down here and fill this gap and probably spike it. But at 155.40 I think it bounces again, and that is another reason XLY and XLK have to be the leaders on the downside for the indices to melt. I think it's very unlikely that things like XLP will fall very much unless bonds fall very much, and I don't see that happening. To me, it's all being led by housing, by consumer durables, and by the discounting of earnings in technology via higher bond yields. Unless those are driving it, it's unlikely that SPX can keep on spiking lower. So to me, this kind of level in SPY is going to be pivotal. I'll be watching that kind of level. And if we don't break or go anywhere near these levels, I think the odds of XPX going below or closing the week below that times 18 level in the on the Blue Angels is extremely unlikely. XLY has to lead on the downside. And here we have several reasons why unless XLY leads, I don't think the market can go that much lower. And this is the equal weight consumer discretionary, consumer staples. I think that once we get, it led the move down, and it also led the spike, and now it's leading the move down again. And really, I think that these levels are going to be extremely, extremely important. You can see how many times they've been touched, and then there were reactions off them. I think next week we could get down here, which, the first part of the week is bearish. We get those kind of levels that I've talked about in SPX, and then we bounce again. I don't think that we are, unless we keep on going, which I think is unlikely, that to me says that once the lows have been broken, everyone's bearish, things bounce back again. And the other reason, I think SPY TLT has finally stopped going up. To me, this move made very little sense on the upside. I thought it would stay in this kind of area. And here we are, it's coming back down. So, what does this say? This says SPY comes down a little bit more and then bounces. Let's assume that TLT does nothing, which I think is more than likely over the course of the next week or so, certainly the next couple of weeks before we get the Fed. SPY comes down more and then bounces. That's what that chart says. I think we go into the Fed at around this level of SPY TLT. That would make sense to me. Therefore, can I be bearish of SPX? Yes, absolutely I can for the first, 3, 4, 5% from here. But after that, anything above that, I think gets reversed. With a very important week for earnings next week, I'm especially concerned about Amazon and Apple. Those are the two that concern me most because they are, in a way, consumer discretionary, aren't they? And basically, I would like to see Amazon take out the lows and come down to 2410 and then bounce. So that to me is the level that Amazon is interesting at, and you can see the correlation between this and SPX. New lows, everyone gets bearish, bounce back up. And the one that's had earnings, but I will show you because it also makes sense, is JPM at around this 116, 117 level, because JPM has been leading this move down. It just refused to go higher, and it's now leading the move down. I think around this 117 level, I would love to see, I would love for that to be the bottom in JPM. And that would coincide with the bottom in SPX. That would be deeply oversold territory from which it bounces hard. Very good risk reward at 116 in JPM. Now, Apple is the other one, which is on the weekly charts. I think if we get this kind of level, 153, and I can actually go to the previous high here, this kind of level, 154, 155, if we see that level, that would be through the Bollinger Bands, and it would be quite interesting to see how Apple reacts there. That also to me argues for a hold in Apple, and if Apple holds, or maybe just takes out these lows and then comes back, everything is going to be fine with the market. As to foreign markets, I think the one least likely to get pummeled at any stage is actually Nikkei, simply because of what the yen is doing and will probably continue to do. If you hold the 10-year at 0.25, it's unlikely that your currency is going to do very well. So really the levels in Nikkei haven't changed at all. It's bearish below 26,195 on the week, but this kind of 24,975 to 24,050, I think it's extremely unlikely to remain broken, and I think that you get a very vicious bounce from those levels. So to me, the Nikkei is probably the least bearish of all the of all the foreign markets, and the one that where I would expect the least downside. Stocks, I think, is extremely likely to test 36.24, but I think it's also extremely unlikely to close much below 35.40. I don't think we make new lows. I think we retest these levels and then bounce again. And that is why I also find it unlikely that SPX can close at new lows for the year this week or next. I think we can try it, but I think it's going to be, a bounce territory from the levels I showed you. I don't think Europe is ready to give up the ghost yet. I think certainly this 36.24 level is going to be, excuse me, very, very important indeed. And probably there you are looking to cover any shorts for sure. And lower down, you're looking to, in this kind of area, just below 3,600, between 3,600 and 35.40, 2040, you're definitely looking to buy some calls. And finally, my friend, volatility. I keep on warning you, there's this gap here between 34.25 and 35. Volatility always fills gaps, just the question when. I think that we are likely to do it, even next week, and that's why I think that eventually we're going to have this mismatch between volatility not making new highs in the year and the SPX making new lows. And that is what triggers our rally off that break of the new lows if we get it. That to me makes sense. I think that we are, sort of every time we break 30 on the upside or on the downside, we get a quick 4-5%. So if we go to the weeklies, you can see that we get, considerable moves from 30 to the upside and to the downside. If we break it from above, we get a move down to 20, and if we break it from below, we get a move to at least 35, 36. So that to me makes sense. It just makes sense that we that we break the lows, get everybody bared up, and then we have rallies. And finally, on to the bias table. To me, the most important thing will be if this is stable and these levels here hold. If that holds, then I think any retests of the low and spikes of the low in the equity sector are going to be short-lived, and certainly an opportunity to buy. Also, gold, if it starts spiking down, I think there is a very good opportunity at these levels. First of all, at 1881. Gold is going to perform now better than DBC. I'm convinced of that. And these levels in DXY seen could be historic levels to get the hell out. And that actually would help equities quite a bit. So it should be quite an exciting week. And at some stage it will go quiet ahead of the Fed, but that's probably for the week after that. I really do think that any spike below the lows of this, of in SPX below the lows that we had in whenever it was, February, March, that those will be opportunities to buy. I think the market is just not ready to have a proper growth scare as yet.